Welcome to Westminster College Center for Financial Wellness. This lesson is on the balance sheet equation. All right, in the previous section of this course, we learned about the four main financial statements. Those financial statements are used by analysts and creditors and investors and other agencies to understand the financial situation of a company. By analyzing the financial statements, these external users can gain an understanding of a company's past performance, its current performance, and future potential. In this lesson, we will focus on the balance sheet equation as an analysis tool to help us understand how transactions that a company participates in impact the financial statements. And we'll be focusing on the balance sheet. Okay, as a reminder, the four main financial statements are the balance sheet, which shows us the assets that a company has or has claims to use, and the claims against those assets. Income statement is the next one, which provides information about a company's operations. This financial statement shows net income, which is calculated by subtracting expenses from revenues. Remember, we have the cash flow statement, and it displays changes in cash. We categorize it in three areas: operating activities, investing activities, or financing activities. And then we have the statement of stockholders' equity. And this financial statement provides information about how the owner's equity claims have changed. Again, we'll be focusing mainly on the balance sheet in this lesson, but we will also learn how the balance sheet is related to the income statement and the statement of stockholders' equity. All right, the balance sheet equation is assets equals claims. This equation shows that all assets owned or controlled by a company must equal the claims on those assets. The balance sheet equation can also be shown with claims being further broken down into liability type claims and equity type claims. Okay, this version of the balance sheet equation shows that claims can either be external to the company, that would be the liabilities, or internal to the company, that would be the equity. If you remember in the prior lesson, we did the example where there was a car that was an asset and the owner had liability claims against it from the bank of 20 and equity claims of their own because he gave his own cash of 10. All right, so the balance sheet equation needs to be even more detailed. Rather than using the high-level elements, which are the assets, the liabilities, and the equity, we can break it down further into what we call accounts. Okay, this is an important level of understanding because accounting transactions are recorded into the level of accounts. So these are the accounts right here. Thus, this level of detail is typical in accounting systems. They will enter the transactions or record the transactions for a company at the account level. We can choose to analyze on an element level or an account level, but we're going to learn account level at this point. Okay, again, the higher level elements are the assets, the liabilities, and the equity. Shown below each of these, I've just given some sample accounts that are common to companies. For example, a company may have assets of cash and accounts receivable, inventory, etc. Likewise, a company may have liabilities of accounts payable or some bonds, and equity accounts of common stock or retained earnings. Okay, these are just some example accounts. There are many, many accounts. And the accounts that a particular company will use will be specific to that company. For example, you would expect a manufacturing company to have a lot of equipment that helps them to make maybe some inventory. That would be common. Whereas, say, a law firm I wouldn't expect to see in their assets any inventory and probably not as much equipment either. So the makeup of the accounts that a specific company has will be particular or specific to that company. Okay, just as a reminder, remember that assets are the stuff that a company owns or has rights to use in its operations. These are the things that they use, like my example of the equipment. The equipment helped to make the inventory. So these are going to be, the assets are the things that they use to help them in their operations. Liabilities are amounts that the company owes to external entities, like a bank or another vendor. And these are external claims, all these examples of these accounts. Equity has two main accounts, and both are internal claims. Common stock represents the equity from owners contributing to the company. For example, they're buying common stock. Retained earnings, on the other hand, is very different. It represents the equity that has been earned by the company through running its operations. We will come back to this retained earnings account later on in the lesson today. Okay, so here's some examples of, again, the elements in the balance sheet equation and some of the accounts that are common to those elements. All right, illustrated here is an example of a balance sheet equation for a company. It shows that this company's assets of cash and accounts receivable and equipment are equal to the claims of the loan, the common stock, and the retained earnings. This is very, very simple math. Okay, just to relate the balance sheet equation to what we learned in a lesson on financial statements, illustrated here is the exact information as shown in the previous slide. So let's go back and look at it really quick. So we had some asset and cash, accounts receivable, equipment, totaled 550. Okay. But the information shown on this slide is shown in a balance sheet format. The balance sheet shows same cash, accounts receivable, and equipment equals the 2,550, and those equal the claims, the external claims and the internal claims. These two, the 1,570 and 980, equal 2,550. So the balance sheet is the balance sheet equation. We use the balance sheet to communicate to external users. That's the nice format, the headings and the labels and stuff. We use the balance sheet equation as a simple tool to emphasize the mathematic equation. It focuses on the relationship between the elements of assets, liabilities, and equities. Thus, it's a much easier tool to use to analyze. All right, okay. Now, let's see. Now that we've reviewed the balance sheet equation, assets equals liabilities plus equity, and we've learned a bit about how these elements of the balance sheet equation can be broken down into accounts, and we understand that the balance sheet equation is just a simplified balance sheet, we're ready to use the balance sheet equation to analyze some transactions. Okay, in this transaction, we have our company, Tamed Lawn Care. Just going to call them TLC. They're going to get a loan from the bank. Okay, to analyze this, we will consider which accounts that this transaction would impact, and we consider if it increases or decreases those accounts. Finally, we'll ensure that we keep the integrity of the balance sheet equation. Assets must equal claims for the transaction. All right, so by getting a loan, TLC will impact their cash account, right? They're going to get cash, and the cash is going to increase. Also, TLC will commit to paying back the bank. This is a liability because the bank is an external entity. They have claims. We will use the account called loans as our liability account, and the loan is going to increase. So we show in our balance sheet equation that cash assets will increase by $1,500 and the loan liability will increase by $1,500. And the balance sheet equation is in balance. Assets equals claims. Okay, note that at least two accounts are impacted by this transaction. You may have heard the term double entry accounting. Well, it relates to this fact that a single transaction will always impact at least two accounts. Okay, let's look at another transaction. TLC is purchasing a lawnmower for $900 cash. Maybe that's why they got the loan, huh? Okay, for this transaction, TLC's cash is going to be impacted and it's going to decrease. They're going to use the cash to buy the equipment, right? Okay, so TLC is going to obtain a new asset, the lawnmower, and I'm just going to use the equipment account that we have here because lawnmower is equipment, right? And then since we're buying the equipment, that equipment account is going to increase. All right, so cash asset is going to decrease by the 900. The equipment asset is going to increase by 900. The net impact of this transaction is 0 on the assets. One is increasing and one is decreasing by the same amount. Okay, so is the balance sheet equation still in balance? The answer is yes, because a 0 net change in assets equals a 0 change in claims. Okay, sometimes this kind of transaction is called an asset exchange transaction. The company simply changed one type of asset for another with the expectation that the one that they're purchasing is going to be more productive in their operations. All right, another transaction example. Okay, TLC mows lawns and receives some cash. Okay, it's important to remember that in this transaction, TLC is mowing lawns. That's what TLC does as a business. It's their operations. Thus, this is an earnings type transaction. Do you remember which claims account we use to indicate earnings equity or earned equity? We talked about it before, and it's the retained earnings account. So the accounts in this transaction that will be impacted are cash and retained earnings. Okay, they mowed the lawns and they're going to receive cash. So cash is going to go up by the 400 and they earned it by mowing the lawns. So retained earnings is going to also increase by the 400. So TLC's balance sheet equation is in balance. Okay, assets equals claims. Yep. All right. So it's important to understand the claims in this transaction were specifically internal claims that were earned. So we're going to return to this concept in just a few minutes. Okay, if we pause here and summarize the 3 transactions we just went through, we can kind of prove that given all 3 transactions, the assets still equal the claims. We're just going to do a little math. We're going to simply add up each of the columns, which represents an account. So for example, the 3 transactions impacted our cash account by increasing a net of 1,000. The total impact on my loans was the 1,500, etc. Okay, further, these transactions impacted total assets by 1,900, increasing by 1,900, and our claims likewise went up by 1,900. Okay. Let's take a deeper look into the internal equity claims represented in the retained earnings accounts. Okay, from our previous slide, we had a $400 increase in retained earnings. Let's go back and look at that. Okay, remember, TLC earned this $400 in cash. They earned it by mowing lawns. So that's their operations. And they have claims to that, internal claims. We're going to look at the relationship of this account, retained earnings, in the balance sheet to net income on the income statement, and also in the statement of stockholders' equity. So, all right, lots of words here, and I kind of apologize for this slide, but bear with me. Okay, the retained earnings account displays the cumulative amount of ownership equity that a company has earned from inception, from the first day that they opened doors. If you remember, though, the income statement is the financial statement that provides information about current earnings. Its bottom line, net income, which is revenues minus expenses, equals the net income. So these two amounts, the retained earnings on the balance sheet and the net income on the income statement, must relate somehow, right? But it's a little more complicated because net income doesn't go directly into retained earnings on the balance sheet. That would be just far too easy. Instead, net income first goes through the statement of stockholders' equity, okay? Because net income earnings changes owners' equity claims. And the statement of stockholders' equity is where we explain that change. Hold on, I promise it'll make sense. So net income originates in the income statement, rolls into the statement of stockholders' equity, causing retained earnings to change. And then the ending retained earnings amount on the statement of stockholders' equity is then included on the balance sheet. Okay, that's a lot of words. Let's show some pictures. All right, so here's a picture of what I was saying. We have our four financial statements here. We're going to focus on the income statement and the statement of stockholders' equity and the balance sheet. Specifically, we're going to trace how net income gets from the income statement to the balance sheet. All right, here's our net income of $59,000 on the revenues minus the expenses. Notice that it flows down into the statement of stockholders' equity. It flows down into the section called retained earnings. We know that. And explains part of the changes to retained earnings from one period to the next. Specifically, our $59,000 increases our retained earnings. And in this particular statement, we have two decreases to retained earnings of 13 and 73. So if we take our 98, add our 59, subtract about 86, we end up with an ending retained earnings of 70,400. Okay, so net income goes into our statement of changes in statement of stockholders' equity. We get an ending balance and retained earnings in this account, in this financial statement, and it rolls into the balance sheet. The ending retained earnings is what goes into our balance sheet. So there's our 70,400. So that's how the magic happens. It's important to understand these relationships because, again, the financial statements are related. As we're analyzing using the balance sheet equation, we're actually impacting other financial statements too. But it's important to understand how that retained earnings is so interrelated, especially with the income statement. All right, one more look at this concept. This one's a more simplified illustration. We can see that the equity section of our little Doppel company here on December 31st, 2021 has a balance of $5,000. Okay, so the next year rolls around and we have revenues and expenses, and the net of that, the net income, is $850. That net income of $850 rolls into the next balance sheet, into the equity section. So now we have $5,850 in equity. We're kind of assuming that retained earnings is the only account in that area. Okay, so that's a more simplified view of the previous slide. Okay, in accounting, we actually close the income statement accounts, the revenues, and the expenses. We create a transaction that zeroes these accounts out, and we transfer those amounts into the retained earnings account. And the retained earnings just shows the accumulation of all of our operations for each year. Just like people, we tend to think of income in an annual time periods. So the question, how much do you make, would usually be answered with something like, I make 50,000. We wouldn't answer that question by giving the amount of earnings we'd earned since our first job. We answer it with our annual earnings, and companies are kind of the same way. We look at earnings annually, but the balance sheet shows the accumulated effect of all those earnings through each year. So we close the income statement accounts each year, and we start over on those, but we transfer that wealth generation into the balance sheet. All right, that is the end for this lesson. Go ahead and take your quiz on this section, and good luck. And I will see you in our next lesson.
My name is Rick Haskell, and I'd like to thank you for watching this video as part of the Bill and Vieve Gore School of Business's Business Certificate Series. I'm a finance professor in the business school, where I'm also the director for the college's Center for Financial Wellness. The Business Certificate Series is offered through the Center as part of our outreach through the Gore School of Business. You can follow us on social media through Westminster's Instagram, YouTube, LinkedIn, or Facebook pages. You can use the QR codes provided or simply go to these websites. Thank you.